Welcome to this Killik Explains finance video. This week, quite an interesting topical topic, why short-term stock market predictions rarely make sense, and we'll use this year as a prime example. So as a long-term investor, turn off the noise. It's probably not helpful, and beware anyone carrying a crystal ball, lest they be carrying crystal balls, as I put them. So, background to this is what? If an analyst were clever enough to nail the earnings number for the entire S&P 500, they could never in a million years reliably predict the multiple. Now, if you're thinking, what is that saying? It is basically Josh Brown, the reformed broker, respected commentator, basically saying, watch out, because earnings are only part of the picture. The earnings multiple, as it's called, is a key component of where stock prices end up for the year and therefore total returns. And whilst you might have a handle on earnings, I bet you don't have a handle on what can happen short term to the earnings multiple. But it's all not doom and gloom. There is a positive message at the end of this video. Okay, so the problem is this. Stock market total returns. Now, I'll cover this in more detail elsewhere, so this will be brief. Can be stripped down into basically three component parts. Dividends is a key part, but not the only part of the story, for the simple reason that the stock market doesn't pay out all its earnings as dividends every year or anything like that. So dividends are a key component of stock market total returns. Many people buy stocks for income. Earnings is pretty critical, and I've put in brackets the market's EPS consensus. There are various ways you can look at earnings, but let's say it's the market's EPS consensus when you're dealing with a broad index like the S&P 500, for example, or a stock within it. And the valuation multiple. It's that bit at the end, it's this bit over here that basically Josh Brown is saying be very, very careful. You need to understand the implication that can have on stock prices, and to understand that, you need to understand where it comes from. So without going into all the science now, I'll give you some of the factors that can move it. Okay, so how does it actually all add together then? If you take those three ingredients, what do total returns look like over the last few years for the biggest market in the world, which is the US, as represented by the S&P 500? So the S&P 500 so far looks something like this. Now, if you break down total returns, this is total returns, okay? So income and capital gains, if you like, the S&P 500. Something interesting, if I can call it that, happens in 2018. And it's this. Essentially, from the sort of, there was a lull around here. From 2015, what you see is a sort of pattern of, if you look at these three chunks, so the different multicolored bars, if you like, are respectively dividends, earnings per share consensus, mentioned just now, and this thing called the PE multiple. Quick refresher on that coming up in a moment, in pink. You see that what's happened is, as the multiple has expanded, that's the pink, EPS has risen. Basically firms have been delivering good earnings, to translate that into English if you like, and dividends have stayed fairly steady. What that's meant is the total return available to an investor has more or less done that. And then suddenly, in 2018, things have changed. But what's actually changed to reduce your total return to almost flat, if you want to see it that way? It's almost sort of zero for the year, right? For a flat market over the course of the year. So what's happened? It's the pink that's changed, right? So suddenly the pink's gone negative. Now, what does that actually mean? What it means is underlying earnings, all right, are looking pretty decent, pretty strong, almost up to the best part of 20%, if you want to see it that way, as a figure for the year. Dividends adds another slice on top. But that's been countered by the change in expectations as represented by the earnings multiple. So the fact the pink bit has gone negative and dropped has basically taken all of that away. So you've ended up in a year with decent earnings where stock prices have been flat or worse. And total returns will be pretty unimpressive, potentially. And I speak 1 month or so away from the end of the year. Now, in summary, therefore, dividends have remained relatively steady. All right? Earnings have been reasonably strong and growing since, say, 2015, but unfortunately, multiple expansion became contraction in 2018, and that has a big bearing on share prices, and that has a big bearing on total returns. So what is that pink bit? Well, without going into all the science here, I do more on this in other videos. Essentially, why do multiples contract? Now, don't forget that the PE multiple is the price per share over earnings per share as a number. So essentially the share price, if you rearrange that equation, can be expressed as earnings times the multiple. So the multiple is really important. It's the key ingredient, if you like. And sentiment is reflected in PE multiples. Now, earnings, if you like, are reasonably well known. You can get a handle on those, so are dividends, but the multiple is all about expectations. Sentiment in the stock market can shift very quickly in the short term. As a long-term investor, be aware of that and be aware of the impact it can have on total returns. But it can shift back. That's the point. Liquidity. That can affect the PE multiples. You might have decent earnings, but if people could start to get nervous about liquidity, their ability to exit the market, their ability to sell when they want to, whether it be gated funds or whatever it happens to be, or or moving to another market, bonds or a certain part of the equity market, that can suddenly change sentiment, and that can pull down total returns via the multiple. It's called multiple contraction, to give it its jargon. And the macro backdrop. Donald Trump's not been helping. Saber rattling over China. Situation in Saudi Arabia has been pretty unstable this year. There's the Eurozone, Italy, Brexit, and so on. So that, cumulatively, is enough to make analysts nervous, especially when you push in, probably most important of all, the change of direction on interest rates we've seen led by the Federal Reserve in the US. Enough to make people nervous. And they can put that through stock prices and total returns using multiple contraction, as it's called. In other words, condensing their expectations for the future. Now, that all sounds pretty depressing so far, and it helps to explain why total returns for this year are probably going to be fairly flat, depending on where the stock market ends up by Christmas. But there is an opportunity here. Now, you need to measure it carefully. It's not a gift. The market doesn't give away free lunches. But although predicting multiples is a fool's game, that was the message from the very first slide, Josh Brown, and he's right. Short term, you'll never get that right. You're trying to basically second guess the market, and that is a fool's game, a bit of a waste of time. But for long-term investors, if you see a situation where multiples are contracted rapidly and quite some distance against underlying earnings that you have some confidence in, and you could be looking at single stocks at this point, you could be looking at the broad market, then you might think to yourself, is there actually a little bit of an anomaly here? Has the market overreacted? Is this potentially a decent entry point? This is not timing the market. This is not selling and then buying back and all that, but it is saying, well, actually, I'd considered getting in, all right, at this point, whether it be particular stocks, particular funds, blah, 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 or the market as a whole. Maybe this is a good opportunity to do it, all right? So there is a positive note, potentially for long-term investors, stress that phrase, from the fact that it's dangerous to try and predict earning multiple expansion or contraction. Covered lots of ground there. So as usual, queries to editor@killik.com. And if you'd like to watch other videos related to the topic in hand here on P ratios, for example, on multiple expansion and contraction, then it's killik.com/learn and the shares tab.